So we'll go 3, 2, 1. Welcome to FinanciallyEducating.com and our webinar series. My name is Matt Huggins. I'm here today with Dave Vopp. He's kind of our mortgage specialist. We're going to spend some time today talking about mortgages and what's going on in today's mortgage world. So I'm going to kind of hit you on the spot right away, Dave. So can you give us kind of a background of where we've been, kind of where we are now?
Absolutely. I mean, it's pretty much common knowledge that 2008, the economy changed, and obviously the mortgage industry itself was, taken down quite a bit, which changed the whole complexion of what the banks were doing as far as lending. So ultimately, they tightened up what they were going to, who they're going to lend to, the type of qualifications that are required, and it's kind of taken a little while, but it's trying to loosen up now, and that's what happens with banks. They'll correct, they'll get real hard one way once the major stuff went down, and then they're correcting now to start loosening back up. So hopefully that means good things for the market as far as people being able to qualify and get in their homes here in a short bit.
So for today's person looking to get a mortgage, what would be, so like credit scores always, they talk about credit score all the time. So where would I need to be?
Right.
Is there a range? Is there?
Well, I mean, obviously that's what everybody hears. Everybody hears the credit score thing, and that certainly is a main driver. It's been that way for quite a while now. The mortgage industry back in the day, you didn't hear so much about the credit scores, but now that's pretty much what lenders want to see, and there are different parameters they want to start at. For instance, your A borrowers are going to be 720. 720 is going to be somebody that could get a conventional conforming product. As soon as you move down into the 600s, you're pretty much these days rolling more into like an FHA type of loan. The good thing about those is that they will go down into the 500s. Some lenders are even starting to loosen up to the point where you could get a loan, with a score well into the low 500s. That typically changes is the pricing on those deals. It also probably additional requirements that the bank might look for as far as assets, money in the bank, and that sort of thing. But somebody that's trying to qualify for an FHA loan these days would want to think be at least around the 580 on up type of range at this point.
Looks like we have somebody who has a question. Wendy, did you have a question for Dave?
I do, thank you. Dave, my credit score is 580, and I was wondering what I can do to improve this as I move closer to purchasing a new home.
That's a good question, Wendy. I mean, there's a lot of things that can be done to improve your credit scores. Ultimately, credit scores are driven by the amount of accounts that you have, how much the balance is to the high credit limit, if you've got derogatory credits, obviously collections and judgments and things like that affect the credit score. Unfortunately, a lot of people think they can just go and start paying things off and try to take it on their own to try and improve their credit score. And sometimes, it's not necessarily the best way to go. There's a lot of credit restoration companies out there now, and you have to look around because there are some that you don't want to necessarily trust, but there's some good ones out there that can give you the right advice and probably steer you in the right direction as far as what you should do for your individual credit report and how you can improve your score. A 580 is not a bad score. You can definitely get an FHA loan, depending on the lender, and but obviously anytime you improve it, 640 is a good mark to set it for, and of course anything further up from that is even better.
Okay, thank you.
Thank you, Wendy. That was a great question. They also talked about in needing a mortgage, there's a ratio.
Mm-hmm.
And could you tell our listeners, how does that work?
Sure. I mean, ultimately, the bank wants to know you can afford to pay their loan back. So that's based on the amount of income you have. Gross income is what they calculate it off of. But it also has to do with the amount of debt that you carry. So if you have a lot of debt, even though you might make a lot of money, you may not qualify for as much home because they have to look at how much your credit card debt is, how much you have as far as student loans potentially, also car loans, and anything that would show up on your credit report, that will be factored into the ratio. So there's a front and back ratio. The front ratio is strictly the housing expense to your gross income. The back ratio is your housing expense in addition to all those types of other debts that you carry. And for FHA, they're looking for a front ratio of no higher than 31 and a back ratio of no higher than 43, unless you have potentially higher credit scores, and then the underwriting system may allow for that ratio to be increased a little bit.
So when you talked about the front ratio, you said gross to the house cost?
That's correct.
So what exactly does that mean? So when you say gross, for those who may not know, what exactly does that mean?
Well, the gross income that you make, your annual income before, taking out any taxes or anything that comes out of it. That's what they calculate that off of.
Okay.
And the reason why they set those ratios is because they want to know that you still have another 60% of your income that has to go towards groceries and gasoline and all the other necessities that obviously you need to live.
So they want you to eat as well
Yeah,
as own the house.
exactly.
So they're trying to help you out a little
Yeah,
bit.
you don't want to go to ketchup sandwiches and oodles and doodles and that sort of thing, So.
So in the back, so how's the back end different from the front? So the front is straight gross
Right.
and the cost of the house. The
Yeah,
back end is then,
The back end typically ends up being the deciding factor because everybody carries debt. I mean, there's not too many people that aren't carrying some sort of debt. You've got to have a car, payment that you're making. You've got to have a credit card. I mean, there are people, but obviously, for the most part, somebody's going to have that kind of debt. So that factors into how much you can, how much how you can afford because we've got to take into account how much you're paying on these other debts that show up on your credit report.
okay. Is there another question out there? Christina, did you have a question for Dave?
Yes. I'm not sure what my credit score is, and I was wondering where I could go to check my credit score and if that would affect my credit negatively.
Okay. Yeah, there's a lot of stuff on the internet that you can get these days. There's an annual credit report that you go and see. They've made it really good for people to be able to go out there and check their credit at least one time for free, and not have it affect your any of your scores at that point in time. I don't want to necessarily recommend any. I would just suggest if you go in there and you can Google just about anything these days, obviously, but there's some good ones out there that will allow you to get all the scores, do it for free, and obviously not have to worry about that inquiry adversely affecting the number.
Thank you.
You're welcome.
Thank you, Christina. Good question. So we covered some, so the front end, we covered the back end of the mortgage. Now there's FHA and conventional. So what's the difference? So for me being the layman, I don't know anything about mortgages.
Sure.
They tell me, well, you qualify for this or not. What's the difference between those two?
Well, I mean, conventional mortgages, as I kind of alluded to earlier, are basically set up for people that really have the stellar credit. Okay. And that's a conventional conforming product. And you pretty much have to assume a 720 score to even be considered there these days. It used to be much lower than that, but obviously, as I said, things have changed in the industry, and they're still making adjustments to that. The FHA program, which is underneath of HUD, is essentially, it was originally set up for first-time home buyers, give them a better, lower down payment. So you have to say the difference: lower down payment for an FHA loan versus a conventional loan, and it was a way for them to get in with less money down. And the guidelines that they had as far as underwriting guidelines were a little less stringent. They were subject to the interpretation of the lender and the underwriter at her discretion based upon what she saw as a total picture of their, of their credit portfolio.
Okay. So, it's been great having you here today, Dave. Appreciate all the information because there's lots of stuff I didn't know. Hopefully we helped some of you out there. We're in the future. We're going to be doing lots more webinars and bringing in experts. So come back, check out the calendar on the website, and come join us next time when we have a webinar. Be good.
Nice.
How'd we do there?